definitely in the credit markets, we're seeing something that's comparable to 1998. But 1998, we were living in a completely different world,
Yes.
a completely different economy. I mean, this was even before China entered the WTO. Remember, that didn't happen until the U.S.-China agreement of 1999. The big deal at the time was Russia, if you can believe that. Russia was the one that was integrating into the global markets, and it was Russia that had the default. And that default set off a panic in the credit markets and widening of spreads, and it even caused weird things like a big widening of rates or yields between the on-the-run and off-the-run Treasuries, which eventually led to the LTCM crisis, which eventually led to the bailout. Now, if we didn't have a recession, if we didn't have a recession in 1998 in the U.S., it was because the Fed acted with alacrity. It started to cut in the summer.
And Wall Street came in themselves and fixed it.
Well, certainly with the bailout of LTCM, which was organized by the New York Fed. But I think
who's going to? I got to
so there are differences.
But Terry, there's huge differences, and the answer is in the gossip. Folks, line up the fancy billionaire hedge funds. They've been playing a fancy game that only you know from Vassar, and the answer is Dr. Wizman. Who do we deserve to bail out those guys if we lose liquidity and this gets worse? Is Jerome Powell supposed to bail out the hedge funds?
Yeah, if you're reducing interest rates in a soft economy with inflation coming down, I don't think anyone considered that a bailout, right? That's just saving the economy. And I think that if you do it certainly after there's a lot of bankruptcies, it's certainly not bailing them out either. The problem in the U.S. economy, if there is one, is that we do have a shadow banking system that's large. We have a private credit industry that's large. We have a private equity industry that's large. A lot of those managers, a lot of those assets are in the unregulated space. It's been tough to ensure that they do not over-leverage and that they keep a restraint on their lending activities in recent years. Those are the guys I worry about because they're hidden, they're behind the scenes, they're secretive. We really don't know the extent of their exposure. Is there an analog to 1998? Yeah, look, I'm not suggesting that there's no parallels, right? But the difference with 1998 is we had a booming AI economy. We're coming just into a dot-com bubble. So the combination of the Fed cutting and this emerging technology in the U.S. kind of saved the U.S. And we didn't see a big GDP decline in the back half of 98.
Let me make clarity here, Paul. And for those of you younger, everybody older will get this. Paul, can you see a Time magazine with Besant, Hassett, and Powell on the cover?
Sure.
It's just not the same.
Not going to happen. So, all right. So, Terry, we are seeing a big move in the Treasury market here.
Yeah.
I mean, yields pushing materially higher here. People selling almost indiscriminately here. U.S. Treasuries, which used to be generally thought of as safe havens. What do you make of that?
Well, first of all, that's very different than 98. 98, the on-the-runs experienced a massive bid in 98. So there's one difference right there. And I think this largely results from the fact that this is a U.S.-driven crisis, not a foreign-driven crisis like in 98, where it started with a Russian default. After a string of emerging market mini-crises, I should add, right? It was very much an external situation. 2025 feels like a U.S.-driven situation and a willingness on the part of foreign investors to liquidate dollar assets. Treasuries are part of that complex. And if you're going to...
Have we seen that before? Foreigners fleeing our markets, whether it's the dollar, whether it's the stock market, whether it's Treasuries. I'm not sure I recall that.
Yeah, so it's interesting. Foreigners will flee the U.S. when times are better abroad.
Yep.
And when times are booming abroad. I mean, the dollar was weak throughout, the period from 2002 to 2007 to the crisis. That was a weak dollar environment. But it wasn't a weak dollar environment because the U.S. was about to crash or the global economy was crashing. It's a weak dollar environment because everyone was, excited about Europe and unification. That was a good times dollar weakness. Now we're having bad times dollar weakness.
Let's regroup here, folks. Across the nation, good morning on your commute. Good morning on YouTube as well, building every day. Subscribe to Bloomberg Podcast. Just humbled by the response. Thank you for the comments over the last exhausting week or two, and ever more exhausting today. If you're just joining us, Paul Sweeney stepped in the studio something in the vicinity of 4:30, and futures went down.
Exactly.
Futures negative 70. The VIX out to 54.91. Frankly, I'm surprised it's not higher yet. Oil flat out gives way. China tit for tat, 84% tariff. This will be on Duke University reverse weave sweatshirts. $56.10 on oil. Dollar fractionally weaker, but there's all sorts of nuances in the pro spread market. So as an economist and someone looking at 60,000 feet, and I want to take you back to Alan Schwartz and what he built for you at Bear Stearns years ago, Malpass, writing, world-class bonds, Emmy down in Latin America, doing Latin America like no other firm. I'm almost out to 4 standard deviations on a full faith and credit 10-year compared to this newfangled LIBOR called SOFR. 4 standard deviations to me in finance, Dr. Weissman, signals something. If we get to 4 standard deviations on that chart, what does it signal?
Well, that there's dislocations in the plumbing of the credit market and the short-term overnight market. I mean, people use treasuries as collateral, so they're going to, and they're accepted everywhere. So that's going to be the preferred place to park your cash in times of crisis. SOFR is effectively a private market, and with a tinge of interbank lending. When people are worried about the ability to pay, they stay away from that stuff, and they put their trust in the full faith and credit of the U.S. government. So that spread widens. But these credit dislocations happen all the time when we have concerns about growth that come on suddenly, I should add. This is not a crisis that has been building up for the last few months. This is a crisis that was self-induced and came across over the last few days. And I think the rapidity and the abruptness of this crisis is what's causing a lot of these dislocations right now.
The Bloomberg dollar spot index off about 4.25% off of its just recent high. How important is that?
I think it's more of a symptom than a problem itself, right? A lot of these things are symptoms. They're not the source of the problem. The source of the problem is the realization on the part of everyone around the world that the era of globalization is over. And if the era of globalization of the last 25 years, I date it back to 99 when China entered the WTO, was a high growth period because of globalization, well, then it stands to reason that anti-globalization or reverse globalization will be a low growth period. If you chop off just 50 basis points from annual global growth over the next 25 years, that is a very, very serious destruction of wealth over the next 2.5 decades.
Bring it over to our equity owners here, the thousands of people that listen to us. Thank you so much, folks, who have a 401k, a retirement plan. Maybe they're looking at their house underwater, whatever. Bring this fancy bond talk back to them. The way it filters back to them is, I think, loan demand craters and all that, but far more just real GDP diminishes. Does Macquarie see a dampening of real and nominal GDP?
Oh, yeah, absolutely for this year. And that pertains to the U.S. and
Can you quantify that?
Yeah, I mean, look, we haven't updated this since the reciprocal tariffs came out, but even before that, we were projecting nothing more than 0.5% growth over the next few quarters in the U.S. That's already a diminishment. It's probably a diminishment of about 100 basis points off the baseline at least. But I want to stress here, guys, this is not about the next recession. I just said that if we're entering a period of deglobalization, we're talking about reduced growth prospectively for 25 years. If you add up 50 basis points over the next 25 years and compound it, a recession that subtracts 100 or 150 basis points from growth over the next 1 or 2 years is small potatoes. When you talk about multiple compression in stocks, the reason it's happening right now is people are looking prospectively beyond the next 2 years and seeing a radically changed world with particularly lower growth. In a deglobalized world, you don't have technology transfer. You don't have cross-border investment. You don't have sharing of ideas and innovation. People associate that with lower growth.
I mean, you have a PhD in economics from someplace up in Boston, Harvard. I think that's pretty good. I don't know. So I can ask this question. I think I grew up with globalization, as did most of our audience. I think that was a pretty good thing. Our economy's been great. Why are we screwing with this?
Yeah, no, I mean, this is a valid question. And I think globalization has had winners, but it's also had losers. And I think that the base of voters who elected Donald Trump as president, have been losers. Yep. I mean, there's a lot of people in this country who have not benefited from this, right? It has certainly helped corporations. Their profit margins have improved. They've been able to source labor outside the U.S. Right. The opening of the labor market that happened with the fall of communism in China and Russia was fantastic for global corporations. And at the same time, it depressed wages in the Western markets. If you were an unskilled laborer, you had to compete with unskilled labor in China, for example, over the last 25 years. Okay. And so there have been losers, that's for sure. And I think we're trying to address at this point that widening gap that this is causing.
Let me get one more in here. Folks, Greg Peters of PGIM scheduled to be with us in 30 minutes, and then we have Ira Jersey and Ed Elsini. One more question here with Dr. Wizman. You're gonna love this, Terry. I mean, this is what it's
hit me.
This is what it's about. The first guy in academics who said to me, "Geez, you're really strange, aren't you?" was Benjamin Friedman
Right.
at Harvard
Right.
University.
Who wore bow ties, by the way.
Who wore
a
bow
lot.
ties. That's probably the only reason he talked to me. Ben Friedman and Ken Rogoff got this act going, folks. Ben Friedman, the moral consequences of economic growth. And the heart of that is a system will clear. On a Hayekian basis, we will clear the system. Do you have faith, Dr. Wizman, that the political system of America could clear what Trump wrought?
No, not necessarily. It's very possible that we have a recession. It actually increases polarity and polarization in the political sphere in the U.S. It's not clear that in trying to fix a structural problem, you don't create a short-term problem that makes it difficult to fix that structural problem. This is the issue, right? We don't know if the political structure will survive in the short term in the U.S.
This has been
Another recession, that is.